I'm Safie Russell from SDR Consulting Inc., and we're here today on Business Basics Friday. The goal of this session is to provide some value to small business owners in the space of tax, accounting, and general business, and then have an open Q&A at the end.
Happy Friday to you all. Hope all is well with you. It is Friday, February 17th. Happy tax season to everyone. If you're here live or watching a replay, go ahead and share where you're joining in from. I am currently in New York and it's 57 degrees and rainy, but it's February, so I'll take the 57 degrees. So once again, if you're here live, go ahead and share in the comments where you're joining in from. And if you're here on Clubhouse, you can share in the chat as well. And so let me go ahead and make sure my technology is all squared away. 1 second. Okay, should be good to go. All right, so we're going to go ahead and get started. Welcome to Business Basics Friday. I'm Safietou Russell, founder and CEO of SDR Consulting Inc. Business Basics Friday is a weekly session catered to providing valuable information to business owners. We have a variety of guest speakers that come in and help share information and educate you on the many areas of your business that you may need to manage. This is strictly education and information only, no client relationship or specific advice for your situation with a paid consultation. And SDR is not liable for any information used today. As far as my background, I've been in the industry 20 plus years, and I'm a CPA and enrolled agent based here in New York, but I have a virtual practice, so I do work with clients all over the US. And I mostly work with business owners, especially those in the mental health profession, helping you reduce your concerns regarding tax and accounting so you can focus on your clients and your own well-being. So today I will be a guest speaker, and I'm going to be having an open Q&A session, part 2. I have a few questions that were submitted ahead of time, and so I will definitely be going over those, and schedule permitting, we'll answer questions that are submitted during this live session. You can go ahead and put them in the Facebook live comments or in the Clubhouse chat. All right, so I'm gonna go ahead and pull up my questions here, and then we will get started. So the first question is a GoFundMe donation considered a charitable donation? And what I'll say is that it depends, because there are some registered charitable organizations who are on the GoFundMe platform. And so if you're contributing to one of those, then yes, it would be a charitable contribution. You should get a confirmation letter of some sort confirming that. But if it's just, a friend who's in an unfortunate situation, that is unfortunately not a charitable contribution for tax purposes, because that person is not a charitable organization with the exemptions in place. All right, so for charitable contributions, whether it be cash or property, you want to definitely make sure, in all cases, just keep it simple and make sure you have documentation, receipts, confirmation letters from the charity so that you can qualify for the charitable contribution deduction if you have enough to itemize. You only benefit from charitable contributions if you itemize your deductions. Itemizing your deductions is something that is available to those who have more deductions than the standard deduction that everyone gets. So let's say it's 12,000 and change, or 13,000 or so for a single filer. Everyone gets that deduction. If you have more deductions than that, then you can take itemized deductions. The things that count towards itemized deductions are charity, mortgage interest, real estate taxes, income taxes, although those are limited to about 10,000, medical expenses that exceed a certain amount. So you have to have a significant amount of those things to be able to benefit from the charity. But nonetheless, get your receipts. And if you are doing a GoFundMe contribution, you want to check and see if the underlying organization is a nonprofit, and that will determine if you can deduct it as a charitable contribution. All right. So another question I come across pretty often is that for businesses that are taxed as S corporations, so whether you are an LLC who made an S election or you're a corporation who made an S election, the owner is required to be set up on payroll if they're providing services for the company as an employee. And so the amount of income you pay yourself as an employee, assuming your W-4 is filled out correctly, yes, there will be taxes withheld on that amount you're paying yourself. What isn't being factored in is the amount of profit that may remain after you've paid yourself, after you've paid all your operating costs. There's profit still remaining in that company, hopefully. And that profit is going to flow through or pass through to your personal taxes through a Schedule K-1. There's no current withholding during the year for that profit unless you have adjusted your W-4 accordingly to consider that income, and then more taxes are being taken out from your paycheck as an employee of your company. All right, so when payroll's being run and payroll taxes are being filed, that is separate from quarterly tax payments that you may need to make as a business owner if you're profitable and you have, once everything else is combined with your personal taxes, you still have a tax liability. So if you're an S Corp, long story short, you may still need to make quarterly payments. You likely will still need to make quarterly payments if your company is profitable in excess of the amount it pays yourself and your operating costs. So I hope that makes some sense. The alternative to quarterly payments is just having more withholding taken out of each of your paychecks throughout the year to compensate for that additional income that's going to pass through. So you have your company. Let's say your company makes $100,000. Let's say you have no other expenses, just to keep it simple. Let's say you pay yourself $50,000 as an employee because that's determined to be the reasonable compensation for your role in your company. That means $50,000 will be left over as a pass-through through the Schedule K-1 to your personal return. That $50,000 will avoid self-employment tax, but it will not avoid federal income tax, and depending on where you are, state income tax. And so that's $50,000 you've gotten free and clear throughout the year, or you have access to in your business bank account that no taxes have been taken out for. So quarterly payments are still important in that case, or you need to adjust your withholding accordingly. Okay. Next question. Do I need to file quarterly taxes if the income is low and unpredictable? So just to clarify quarterly estimated tax payments, because there's different types of quarterly payments. For most businesses, that there are pass-throughs, meaning that the net profit passes through to the owners and picked up on the individual return. This means that your tax liability as a whole is determined at the individual level. So you may have a W-2 job, you may be a contractor, you may do Uber, you may have rental property, you may have stock accounts with taxable sales. All of that combined is going to determine your tax liability. And for IRS purposes, if you owe more than $1,000 when you file your tax return, and depending on your previous year's tax liability, you may be penalized for not making quarterly estimated income tax payments throughout the year. So if your income is unpredictable, if it's very low, my suggestion is that every quarter you work with a professional like myself to calculate what your estimated tax payments should be, if any. That is really the only way you're going to get a gauge on whether you need to make a payment or not, because there's so many different moving parts and everyone's tax profile is different. Okay, you're making that quarterly payment under your individual name and social security number, not under the business. However, there are certain business structures and locations where the business can have quarterly estimated tax payments. For example, New York City, for example, California, where the S corporation does have like a franchise tax that it needs to pay. And in some cases, quarterly payments need to be made. New York City, it's the unrelated business tax and C Corp tax, because New York City doesn't recognize S Corps. So work with a professional. As you can see, it can get complicated, but you still may need to make those quarterly payments, even if your income is low and unpredictable, depending on your specific tax profile. So I hope that helps. All right, let me go ahead and move these over here. So the next question is, this person is working as a 1099. I'm going to correct this to say contractor. There's no 1099 employee are opposites. So 1099 contractor working at an agency, and they're having a hard time keeping track of everything. And they want to know, is it worth the headache to try to keep track of everything, or go with a standard deduction to keep it simple? So just to clarify, there's no standard deduction for business expenses. There's a standard deduction that everyone as an individual gets when they file their taxes, or they take their itemized deduction if it's higher. There's standard mileage rate deduction. If you're operating a vehicle for business purposes, you take that flat rate per business mile, but you still need to track your business miles. There's no standard deduction for businesses. So if you're looking to lower your tax liability and offset your income that you're making with the expenses that you've incurred, you need to track your expenses. My suggestion is you have a separate account. If you're a sole proprietor, you may not need a business account, but at least have a separate personal account. My suggestion is just go ahead and get a business account where possible and run all of your business activity through that account. This will make it easier to track what's business and what's personal. If you're not sure what you can deduct, definitely download my ebook. If you haven't seen that, it'll give you 12 examples, 12 overlooked tax write-offs for mental health professionals. You can find that at SafieroussellCPA.com. So that book will help. You can also just Google Schedule C. It's a form that a lot of business owners file as sole proprietors or single member LLCs. It has a list of deductions on that Schedule C that are very common. You may have things outside of that, or you may not be sure where your expenses fall, but at least gives you a starting point. So you want to either have a bookkeeping system in place or have a very well put together spreadsheet to help you track those income and expenses throughout the year. And it'll be much easier to do that if you have a separate account. So standard deduction does not apply for businesses. And yes, you do need to track everything that's business related if you want to minimize your tax liability legally. Okay. The second part of that question was, someone is newly married, and is it better to file joint or separate? Unfortunately, not a yes or no question, but I'll kind of give you some of the things to consider. When you file jointly, both of you are liable if there's a tax liability or, let's say, an issue that arises 2 years down the road or an audit. Both of you are individually and jointly liable for that tax debt, which means that if you're not married in the future for whatever reason, both of you are still 100% responsible for what happened on that return, not half and half. So let's say taxes were filed and it showed a $20,000 tax liability. The IRS will come out to both of you for $20,000 until the $20,000 is paid off. Those are things to consider when filing jointly. Also, when filing jointly, if there's any issues such as back child support payments, student loan payments that are late, your refunds can be confiscated for those payments. Doesn't matter who they belong to out of the two of you. If you file jointly, you have now that joint liability. So those are things to consider. Now, in a lot of cases, married filing joint does produce a better tax result, but everyone's tax profile is different, and so there will be individual variances with that. When you file separate, there's a possibility you lose some credits as well as the itemized deduction and standard deduction that I mentioned can be affected. If one of you itemizes and the other one doesn't, the other one will be forced to itemize, which can lower the standard deduction that they would have gotten. So there's some downfalls to married filing separately, certain credits as relates to kids that will be denied if you're married filing separately. So you want to weigh out all those different factors in determining if married filing joint or married filing separate is a better fit for you specifically. Okay, heading up to my last question. So if there's any questions, go ahead and post them now or forever hold your peace until the next session here. So this one says their biggest challenge is making sure enough taxes are being taken out. I'm gonna take that question first. So we kind of talked about depending on your business structure would determine how taxes are taken out. So if you are an LLC, if you're a sole proprietor, or if you're a partnership, you're not on payroll. You should not be on payroll for yourself. And so it's your responsibility to put aside money throughout the year and then pay those quarterly taxes like we discussed. And so what my suggestion is that you determine, working with your professional, what percentage or what method you should go about using to determine maybe every 2 weeks or every month how much to put aside in savings so that when it's time to make those quarterly payments, you have the money saved. All right. If you are an S corporation for tax purpose or even a C corporation and you're on salary, you want to make sure you're paying yourself a reasonable compensation. You should have an analysis done to determine what that is, and then go through an analysis to see how much withholding you should have taken out of each check. Also considering the other income sources that you have and also any other withholding you may have from a job if you're doing both. Second part of that question is figuring out how to pay themselves correctly or the right way from an LLC. So the common question, how do I pay myself? So sole proprietor, LLC, I'll take those two for now. There's no formal way to pay yourself. My suggestion is that you just pay yourself in a way that is easily tracked. So either transferring money from the business account to your personal account or writing a check. Those are the most common ways. Zelle, if it's available through your business bank. So what I suggest in terms of those structures is figure out how much money you need personally to cover your personal expenses. Develop a budget for yourself for all of your household expenses and whatever, extra fun money you need. And then determine, do you have enough of that profit available in your business to pull that out on a biweekly, on a monthly basis, on a weekly basis, so that you can leave enough money in the business to cover your operating costs. Once you figure out what that number is, then just set yourself up on a schedule to take money out in that way. Now, of course, businesses have their ups and downs, seasonal, you know, maybe year end, maybe the summer can be touch and go. So there may be some adjustments you need to make to those numbers throughout the year, and that's understandable. But I think it's a great starting point to first know your numbers personally and then see how those numbers play into your business. That will help you determine if you are making enough in your business, if you need to make any shifts in your business in terms of direction, et cetera. So in those structures, there's no formal way, there's no formal amount. So you just have to figure out how much you need, and then if you have extra available, you can pull it out. You're going to be taxed regardless of what you pull out of the business account. You will be taxed on the profit made by the business. So whether you leave that money in the business account or take it out for personal use, it's not going to affect your taxes in those structures, sole proprietor, single member LLC. So it doesn't really matter. If you're a multi-member LLC, then you want to refer to the operating agreement, which discusses for each partner what the restrictions are, criteria are for distributions. That's what it's considered when you pull money out of the partnership. You want to make sure you have enough basis or skin in the game to pull that money out so it's not a taxable event. A little bit more goes into figuring out what to pull out or pay yourself when you're a partnership. Partnerships can also do something called guaranteed payments, which is almost like a payment for services. It's the proper way partners can pay themselves for services regardless of partner profits, almost like a paycheck, but you can't be an employee of your partnership unless you're an S Corp, okay? If you're an S Corporation, then you're paying yourself first through payroll until you hit that reasonable comp number, and then you can take distributions after that. You want to make sure you have enough basis for that and all that, and you can do the same transfer or writing a check when doing distributions, okay? So I hope that helped answer those questions. I'm going to check real quick for any questions that have come in live. And if not, we will wrap it up until next week. So I think we're all set. I hope you guys are having a great season, any of my tax professionals out there, and I hope those of you who have not started the process of filing yet are gathering all your documents. I know stuff starts coming in February, mid-February, and then there's a crazy rush in March. So be patient with your professionals who are going to be under a time crunch. All right, so once again, Business Basics Friday. Thank you for joining me live for my CPA Q&A session, part 2. Stay tuned for next week's topic. And also, if you're watching this and you're not in my Facebook group, SDR's Tax Tips, make sure you request to join so you can get the alerts for these weekly sessions and what the topic will be. And I think we're done. Not seeing any questions. So everyone, take care. Have a great weekend. Be safe this weekend. Make sure you do something for yourself this weekend. Self-care is important. And I will see you guys soon. Take care. Bye-bye.